Welcome to your favorite channel for learning everything you need for financial success. Let's get started.
Welcome to the Explainer. We're going to tackle a huge topic today, index funds. You hear about them everywhere, but are they really the silver bullet for investing? Let's figure out if they're the right move for you. All right, let's just jump right in. Look, this is probably one of the biggest questions you'll have when you start investing, and for a really good reason. Getting this right could totally change the game for how you build your wealth. So here's how we're going to break it down. We'll start with the big idea behind index funds. Then we'll look at why they got so popular. After that, we'll get into the nitty-gritty of how to actually use them. We'll cover the risks nobody talks about, and finally, we'll get to the big verdict. Okay, first up, let's get to the core of it all. This simple, but honestly revolutionary idea that pretty much turned the entire world of investing on its head. You gotta love this quote from John Bogle, the guy who basically invented the index fund. Don't look for the needle in the haystack, just buy the haystack. I mean, it just perfectly sums up the whole philosophy, right? Why go through the impossible task of finding that one winning stock when you can just own everything? And this really gets to the heart of the matter. It's about two totally different games. On one side, you have active management. These are the pros who are trying to be smarter than everyone else, to beat the market. On the other side, you have passive investing. The goal here isn't to be a genius, it's just to match the market's return by owning a little slice of all the companies. You're not trying to find the needle, you're just buying the whole haystack. You know, this whole thing didn't just appear out of nowhere. It actually started way back in the 50s and 60s as this kind of nerdy academic theory. Then, in 1975, John Bogle turned that theory into the very first public index fund. But what's wild is that it took decades and a massive financial crisis in 2008 to really catch on. And now, well, now it's a behemoth, making up more than half of all long-term fund assets in the US. That's a huge shift. Okay, so we know the idea, but why did it get so ridiculously popular? Well, as they say, the proof is in the pudding. Or, in this case, the numbers. I mean, just look at this number, $16.3 trillion. That's the amount of money sitting in US index funds and ETFs. That's not just a trend, folks. That is a full-blown revolution in how people are choosing to invest their money. So why the massive flood of cash? A huge piece of the puzzle is right here. Fees. Look at that difference. You might think, oh, what's 0.5%? Well, over 30 or 40 years of investing, that tiny difference compounds into a monster that can literally devour tens, even hundreds of thousands of dollars of your returns. It's just simple, brutal math. And then there's this. This data basically confirms what Bogle was saying all along. It shows, year after year, that most of the pros, the highly paid experts whose entire job is to beat the market, well, they don't. Over the long haul, we're talking 15 years, a staggering 88% of them fail to do better than a simple, boring, low-cost index fund. So you're paying them more for worse results. Ouch. Okay, so the why is pretty compelling. Low costs, and most pros can't even beat it. So let's get practical. Let's say you're ready to jump in. What do you actually need to know before you start buying? All right, so you'll basically run into two main types, the classic mutual fund and the newer kid on the block, the ETF. They're pretty similar, but there are some key differences. The big one to pay attention to is how they're taxed. Without getting too deep in the weeds, ETFs are generally more tax efficient. This is a huge deal if you're investing outside of a retirement account, and it's a big reason why ETFs have become so incredibly popular. So before you hit that buy button, you gotta be your own detective. Here's a quick checklist. First, what index is this thing actually following? Is it the whole US market, or is it secretly just a handful of giant tech stocks? Second, how does it weigh those stocks? Is it based on size or something else? And third, and this is a pro tip, don't just look at the fee, look at the tracking difference. That tells you how well the fund is actually doing its one job, tracking the index. Okay, so far it sounds almost too good to be true, right? Low costs, great returns, but hold on, it's not a perfect system. We absolutely have to talk about the other side of the coin, the risks that people often sweep under the rug. First off, let's just question this whole idea of passive investing. Is it really passive? Not exactly. You're not making the picks, sure, but someone is. You're basically handing over the keys to a committee at a place like S&P, and they're the ones making very active decisions about which companies get in or out of the index. So it's more like delegated management. And this is super important. You are not getting rid of risk. If the whole market tanks, your index fund is going right down with it. There's no magic shield there. Plus, there are some subtle risks, like concentration. Is your S&P 500 fund really diversified if a few giant tech companies make up a huge chunk of it? And there are even hidden costs, not in the fee, from things like when the index has to rebalance its holdings. It's not a free lunch. All right, so we've seen the good, the bad, and the kind of misunderstood. So let's get to it. After all this, what's the final verdict? Should you buy index funds? Look, for most of us, for regular people trying to build wealth for the future, the answer is a pretty clear and resounding yes. The evidence is just overwhelming. Using a low-cost, super diversified index fund as the bedrock, the core of your portfolio, it's just one of the smartest, most effective strategies out there. Period. So here's the bottom line, the big takeaway. Lean into what makes index funds great. The super low costs and the instant diversification. That's a winning recipe. But, and this is a big but, go in with your eyes wide open. Understand that you're still riding the roller coaster of the market. And always, always know what's actually inside the fund you're buying. Know your haste. And I'll just leave you with this one last thing to chew on. Indexing has been an incredible gift for the average investor, no doubt. But now that it's gotten so big, with trillions of dollars moving on autopilot, it raises a really interesting question. How is this massive, passive force actually reshaping the very markets it was built to just mirror? Something to think about. Thanks for joining us on The Explainer.
Before we finish, let me give you a few tips. And remember that we upload videos every day.
Are you feeling completely crushed by debt, especially when you're trying to get by on a minimum wage? Yeah, it's a really tough place to be. But I want you to know you are not in this alone, and there is absolutely a path forward. In this explainer, we are going to build a clear, step-by-step plan to help you start taking down that debt in 2026, even when you have to watch every single penny.
You know, this quote from Experian really hits home. Let's be honest about what debt feels like. It's not just a bunch of numbers on a spreadsheet. It is a huge source of stress. It's that heavy feeling you carry around all day long. So our goal today is to give you a real plan to start lifting that weight off your shoulders.
And hey, if you feel like you're the only one struggling with this, just look at this number. You are definitely not alone. The average debt for U.S. consumer in mid-2025 was over $100,000. That's a massive, widespread problem. But here's the good news. You can beat it. You just need the right plan.
So here's our roadmap for getting there. First, we're going to face the numbers. Then we'll create your battle plan. After that, we'll look at how to supercharge your payoff, find ways to fuel your fight, and finally, we'll talk about how to stay the course for the long haul.
All right, first up, facing the numbers. I know, this can be the scariest part, but it is absolutely essential. You can't fight an enemy you can't see, right? So let's get a really clear picture of exactly what we're dealing with.
So what you're going to do is create a complete debt inventory. That means grabbing every bill, logging into every account, and for each and every debt, we're talking credit cards, student loans, car payments, everything, you write down all these details. This list right here, this becomes your command center. It gives you the full lay of the land.
Okay, once you've got all your numbers laid out, it is time for Section 2, your battle plan. Now we get to choose our strategy. There are two main ways to go about this, and we're going to break them down so you can figure out which one is right for you.
And that leads us to the big question. Are you Team Snowball or Team Avalanche? Now, there's no single right answer here. The best method for you really depends on your personality. Are you someone who gets fired up by quick, small wins, or are you driven by knowing you're saving the most money possible?
Let's start with the debt snowball. Think of this one as the psychological boost method. It's all about building momentum. You actually ignore the interest rates for a minute and throw all your extra cash at your smallest debt first.
The process here is simple, but trust me, it's powerful. You list your debts from smallest to largest. Then you pay just the minimum on everything except for that smallest one. You attack that one with every extra dollar you have. Once it's gone, poof, you get this amazing psychological win. Then you take all the money you were paying on that debt and roll it over to the next smallest one. It creates this snowball of repayment that just gets bigger and bigger.
Now the other option is the debt avalanche. This is the method for all my number crunchers out there. Instead of focusing on the balance, you attack the debt with the highest interest rate first. Mathematically speaking, this is the fastest way out of debt, and it saves you the most money on interest in the long run.
The steps are pretty similar. You list your debts by interest rate, from the highest down to the lowest. You pay the minimums on all but that top one, and you throw every extra cent at that high-interest monster. Once it's knocked out, you roll that payment over to the next one on the list, creating an unstoppable avalanche of payments.
So which one is for you? Well, if you need those quick wins to keep your spirits up, go with the snowball. It works. If you're all about logic and saving the absolute most money on interest, the avalanche is your best friend. Seriously, there is no wrong answer here. The best plan is the one you will actually stick with.
All right, so you picked your strategy. Awesome. Now let's move on to section 3 and talk about how to supercharge your payoff. This is all about finding the fuel, the extra cash, to make your plan work even faster.
A really popular tool is the 50-30-20 rule. The basic idea is 50% of your take-home pay goes to needs, 30% to wants, and 20% to savings and paying off debt. Now, I know what you might be thinking. On a minimum wage, those numbers can feel impossible. But hang with me. The principle is what matters. Just knowing where your money is going is the first step to finding extra cash to throw at your debt.
Our mission, should we choose to accept it, is to shrink that want slice as much as we possibly can, so we can grow that debt repayment slice. When your income is tight, every single dollar makes a difference, and that usually means making some smart, temporary sacrifices.
So where can you find this extra cash? It usually starts in that wants category. Could you switch to free workout videos online instead of paying for a gym? Maybe pause 1 or 2 streaming services for a few months. You could even try a no-spend weekend just to see where your money goes on autopilot. Every dollar you can save and redirect is a...
Okay, now let's dive into section 4, fueling your fight. Cutting back is one half of the strategy, but we can also get proactive and find more resources to really speed things up.
What if I told you there's one single move you can make that costs you absolutely nothing, but could save you hundreds, maybe even thousands of dollars? This is a total game changer, especially if you have high-interest credit card debt.
You just have to ask for a lower interest rate. It's really that simple. So many people never even think to try this, but lenders would often rather lower your rate than risk you not paying at all. It's a negotiation, and you have way more power than you think.
And here's your script for that call. Start with the credit card you've been with the longest. Be polite, be calm, explain you're working really hard to pay down your debt, and be sure to mention your history of on-time payments. If they say no to a permanent reduction, ask for a temporary one. And don't give up if you hear no once. Call back in a few months. Persistence really pays off.
Okay, so besides lowering your rates, the other side of this coin is boosting your income. You know, even an extra $50 a month can make a huge dent. Do you have a skill you could use for some freelance work? Can you sell some stuff you don't use anymore? A few hours of dog walking or rideshare driving on the weekend can add some serious punch to your repayment plan.
And that brings us to our final and maybe the most important section, staying the course. Because let's be real, getting out of debt is a marathon, not a sprint. Your motivation is the fuel that's going to get you all the way to the finish line. So, how do you stay fired up?
Well, don't just stare at the giant final number. Break it down into mini goals. Celebrate paying off your first $200. When you hit a milestone, reward yourself with something that's free but that you love, like an afternoon at the park. Find a friend you trust to be your accountability partner. And remember, there are nonprofit credit counselors out there if you need some professional support.
So, we've gone through the entire roadmap. We've faced the numbers, chosen a strategy, found ways to supercharge it, and talked about how to stay motivated. You now have a complete plan to take back control of your finances in 2026. So the only question left is the most important one of all. What's your first move?
We upload videos every day. Subscribe and become part of the family. See you tomorrow.